Have you ever wondered what a credit score is and how you affect yours? Well, a credit score is like a grade that shows how good you are at borrowing and repaying money. It's a number that tells banks and future lenders if you're likely to pay back the money you borrow. They look at things like how well you've paid your bills in the past, if you have any outstanding debts, and how long you've been using credit. A higher credit score means you're seen as more trustworthy, and it can help you get better interest rates and loan options when you want to borrow money. Now, let's explore the factors that influence your credit score. Payment history is the most crucial factor, accounting for about 35% of your score. Consistently making timely payments on your credit accounts such as loans and credit cards demonstrates responsible financial behavior and positively impacts your score. On the other hand, late payments or defaults can significantly lower your score. Another critical factor is your credit utilization ratio, which represents the amount of credit you're using compared to your available credit limit. It's recommended to keep your credit utilization below 30% to maintain a healthy score. Higher utilization suggests a higher risk of overextending yourself financially, which can negatively impact your creditworthiness. The length of your credit history is also considered. A longer credit history provides more data for lenders to assess your creditworthiness. It's important to establish a credit history early and maintain a mix of credit accounts, such as credit cards, loans, and mortgages, to showcase your ability to manage different types of credit responsibly. Opening new credit accounts can impact your credit score as well. Applying for multiple credit cards within a short period of time can be seen as a red flag, as it may suggest a financial struggle or potential overspending. It's important to be strategic when seeking new credit and only apply when necessary. In addition to these primary factors, there are other considerations that can impact your credit score. These include the types of credit you have, such as revolving credit, credit cards, and installment loans, such as car loans, mortgages, or anything else, as well as any derogatory marks, such as bankruptcies or foreclosures. Understanding the long-term implications of credit scores is essential. A high credit score not only increases your chances of getting approved for loans and credit cards, but also allows you to secure favorable interest rates. On the other hand, a low credit score can limit your access to credit or result in higher interest rates, making borrowing more expensive. Credit scores extend beyond borrowing. Many landlords and property managers use credit scores as part of the tenant screening process. A low credit score may make it more challenging to rent an apartment or require a higher security deposit. Some insurance companies also consider credit scores when determining premiums, as they view responsible financial behavior as an indicator of lower risk. Employers in certain industries may even check credit scores during the hiring process. While credit checks are typically more common for positions that involve financial responsibility or access to sensitive information, it's important to be aware of the potential impact a low credit score can have on employment prospects. To improve your credit score, it's crucial to adopt responsible financial habits, make all payments on time, reduce credit card balances, and avoid opening unnecessary new credit accounts. Regularly reviewing your credit reports for errors or inaccuracies is also important, as these can negatively impact your score.